second day in a row following the Fed's latest 75 basis point hike as investors worry about the likelihood of a recession. And the Fed may not slow down anytime soon. Fed Chair Jay Powell saying that he would have to be, quote, confident that inflation is coming down before considering a pause or a pivot.
Chairman of the U.S. Federal Reserve, Jerome Powell, has used several opportunities to let the world know that former Chairman Paul Volcker is his role model. It is understandable why Jerome Powell admires the accomplished economist. He was responsible for bringing the worst inflation the U.S. has seen since the Second World War under control. Since Volcker's feat in the 1980s, inflation had remained under check until this year. Raoul Pal thinks that the Fed chair is making a mistake in adopting Volcker's approach in addressing the present inflation crisis. Let's listen to his reasons. In a mid-year Gallup poll, 18% of Americans said the biggest problem facing the country was inflation. This makes it a more important topic for the American people, even more than crime, immigration, and even the hot abortion debate, which only 8% voted as a big issue. Mid-year inflation had gone up to 9.1%, the highest since 1981, when the Federal Reserve was headed by Paul Volcker, whom the current Fed chair Jerome Powell is trying to copy. So what exactly did Volcker do back then?
People say, what's going to break? My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt, as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market.
Volcker's inflation reduction strategy has been defined by many as ruthless, and they're right. The Economist did a hatchet job back then, but it proved effective. In 1979, the Fed sent interest rates to 13.7%, and within the next 6 months, it had increased rates even further to 17.6%. Occasionally, rates were jacked up to as much as 20%. Compared to today's interest rate of 3.25%, we can quickly see why Volcker's strategy was dubbed aggressive. Money supply was also stifled, cutting the cash-slushed economy off liquidity that previous administrations had put into circulation. The extremely high rates would cut spending drastically. M2 liquidity, which includes credit facilities, were affected because all credits track back to the Federal Reserve, and the rates for credits, mortgages, business facilities were all up. This slows down the economy. People were not spending money they could afford, and businesses had to work under a spending regimen. The effect of this was not only a decrease in inflation, but a high unemployment rate. Unemployment moved to a high 7.8% in 1980, and only got worse when rates further increased, moving to 10.8% by December 1982. It was a bittersweet period. Unemployment was high, businesses could not access funds, but Volcker succeeded in getting inflation down to 3.4% by August 1987, from its peak 1981 rate of 9.8%. Raoul Pal does not agree that the Volcker strategy of aggressively increasing rates is best. He argues that the times and circumstances are different, citing low GDP growth rate and U.S. record debt levels.
I think actually inflation is negative in 18 months' time. I think they've completely misread the bullwhip. And the bullwhip was post-pandemic, spikes the inflation because everyone comes in the workforce, no supply, overreact to the supply. Yes, they should have raised rates, but not like this. They've misread it. They want to be Volcker. And before they know it, they've destroyed the economy and inflation as well. And they've got their old friend back, deflation.
So Anthony's asking, why are you saying that it's the worst sentiment you've ever seen? And we do have people pointing out that although professionals have sold and are in cash, we haven't seen massive retail redemptions for equities. Do you worry about that, especially if you start
So,
seeing growth slow substantially?
two things: retail don't matter in the equity markets, never have. And the only retail that does count in the equity markets are the millennials who are 401k dollar cost averaging. They're not selling.
Mhm.
They're not punters. So that flow is slow. But if I look at every single part of the Merrill Lynch survey or the AAII survey or the Institutional Investor survey, there are all-time record lows, below 2001, below 2008 on every measure. I've never seen anything like it.
How does the government determine the economy is in recession? Well, one of the major signs is a consecutive quarter of negative GDP growth. The US GDP had experienced a negative growth in the last 2 quarters of this year, falling by 0.9% in the second quarter after a shape 1.6 fall in the first quarter. It is the job of the National Bureau of Economic Research to call a recession. Somehow, they are not doing so this year, despite all bells and whistles being off and indexes pointing to a recessive economy. This year, consumer spending has increased by 4.1% for services and by 5.5% for non-durable goods. Spending is going up, but the GDP is in a negative growth.
We are setting up for lots of opportunity. And for me, it's like, I know it's a kind of worn out expression, but you should be thinking about a shopping list. If you believe in a future of technology, you should be looking at what you can buy and when. Maybe you're a commodity person. Well, they're being thrown out with the bathwater as well. Maybe you believe in the copper shortage story. Well, you should be getting a shopping list out. There are opportunities that are going to come out of this. If there is any form of settling down of what is going on, it doesn't even have to be stimulus. It just can be things settle down, the Fed slow down, everything's returned to normality. There's money to be made. So you need to keep a calm head. You need to see what these headwinds are. You need to see the storms when they're coming and prepare for them, like I am, the physical storm. And then you need to calmly go about what you do.
As the saying goes, buy the dips and sell the highs. Raoul Pal is calling this crash an opportunity. He believes that this is the time people should pick an industry and invest in it. He sees the economy bouncing back in a few months' time, and these assets yielding returns for those who buy into the dip now. The risks are real and should not be taken for granted. Usually recessions last about 17 months, and many experts believe we're already at the tail end of this recession. Don't leave without giving this video a thumbs up, and don't forget to subscribe for more up-to-date market reports like this.